So that kind of brings us to the immediate near-term problem that I and many of my colleagues are most concerned about, which is that in order to deal with this above-target inflation, central banks, and this chart looks at the Federal Reserve, have launched the most aggressive cycle of rate hikes in many, many years. And normally through history, as I hope this chart shows, when they launch into a cycle of rate hikes, one of the consequences of that is something breaks in financial markets. So already in this cycle, we have seen issues in March around the regional banks, in particular Silicon Valley's banks, collapse. And those sort of crises aren't necessarily caused by higher interest rates, but what higher interest rates do is magnify those vulnerabilities, particularly when you are in a tightening cycle, and make those sort of accidents more likely. And it's hard to believe, particularly when you account for the fact that monetary policy operates with a lag, often of a year to 18 months, it's hard to believe, given how aggressive this tightening cycle has been, that we've already seen the last of this. And just to kind of hammer home this point, if we look all the way back to 1831, aside from these individual episodes, the main takeaway from this chart is that whenever you have seen a monetary contraction of the scale that we have seen over the last year, it has always been correlated with some sort of negative economic shock. So this is really giving me pause when a lot of people are saying this time is different, that we might be able to execute a soft landing. It is quite possible we will, but my bias is more towards the hard landing, mainly because of the weight of historic precedent on that side. So just to kind of think about how that is affecting the economy, because we can see this in real time. This is just a chart looking at the 10-year real yield over recent decades. And in the last 18 months or so, we've seen that shoot up by around 3 percentage points. And that's a real yield, so that's accounting for inflation. And that's having a tightening effect throughout the economy. So one of the ways we can see that most clearly is mortgage rates. Housing is one of the most interest-sensitive sectors of the economy. And over the last year, 18 months or so, we have seen mortgage rates, this is looking at a 30-year rate for the US, shoot up very rapidly to its highest level since even before the financial crisis, going back all the way to around 2000, 2001. And that is already having a tangible impact on the housing market, one of those most interest-sensitive sectors, with applications for mortgages for home purchase in the US now down to their lowest levels since 1995. So thinking about that monetary policy lag, my bias is that given we have already seen the effects in some of those interest-sensitive sectors, that the risk is that particularly given the scale of that tightening, that you're going to see that play out in other areas through the economy over the coming months, and that's going to slow down growth significantly.